Investing in ETFs without having a system in place will not get you the results you want. So in this video, I'm gonna share with you a simple 9-step playbook you could implement to retire with more money than you ever thought possible. And make sure you watch till the end, because ignoring any of these steps could be detrimental to your success as an investor. Hey, what's up? This is Elie Irani with Wise Investor, and this channel is all about helping you save and invest your money to grow your wealth and achieve financial independence. The first step before embarking on your investment journey is to pay off your credit card debt, or any high interest debt for that matter. Here's why. Credit card interest rates are around 45% per year at the time of recording this video. There's no investment that can consistently outpace this high interest rate. Therefore, investing while having a high interest debt is like trying to fill water in a bucket with a huge hole in it. Next, build an emergency fund. This is money set aside, typically in a savings account, to cover large expenses resulting from unforeseen events such as a job loss, medical emergencies, unexpected home or car repairs, etc. An emergency fund becomes super handy in these times of need so that you're not forced to sell your investments, especially during a market downturn. The general rule of thumb is to stash away 6 months worth of living expenses in your emergency fund. The next step is to develop an investment plan. And as the saying goes, failing to plan is planning to fail. A solid investment plan must include a few key elements, and I'll be covering these in their own separate videos. But real quick, here are the most important elements to consider in an investment plan. The first is defining how much money you need to retire, and this boils down to estimating your total annual expenses and then multiplying this by 25. The result is your target financial independence number. Next is determining your savings rate, which is the percentage of your income that you plan on saving and investing each month. The higher your savings rate, the earlier you could retire or become financially free. Which leads us to the third point, which is setting your time frame, in other terms, your target retirement date. Next is deciding on your asset allocation, which is the percentage of stocks to bonds in your portfolio according to your risk tolerance. The higher your percentage of stocks, the higher your expected long-term returns, but also the deeper these inevitable falls you'll experience along the way. Next is choosing your funds, which involves picking a couple of low-cost index funds or ETFs. Typically, all you need is a global stock market ETF and a global bonds ETF. Once your investment plan is set, the next step is to open a trading or a brokerage account. Most brokers would let you open a trading account online fairly easily. I've included a list of my favorite international brokers that serve investors in the Middle East or global expats, so make sure to check them out in the description box. Before we continue, if you're getting value out of this video, please hit that like button on YouTube. It only takes a split second, but it helps me a lot in growing the channel to reach more people. Now back to our topic. The next step is to fund your account, typically by transferring money from your bank to your broker. You could start with an initial lump sum and then contribute regularly as per your defined savings rate. Consistency and discipline are critically important for your success as a long-term investor. And here's a bonus tip. Always remember to pay yourself first each month as soon as the money comes in, before spending it and paying everyone else. Once the transferred money has reached your trading account, the next step is to buy the ETFs you have chosen for yourself in your investment plan and according to your asset allocation. You do this by logging to your trading account, typing the ticker symbol of your ETF, choosing the quantity, confirming the price and transaction details, and submitting your order for execution. The whole thing only takes just a couple of minutes. Next, rebalance your portfolio. Over time, your asset allocation, which again is the ratio of stocks to bonds in your portfolio, will drift away from your initial plan due to market fluctuations. For example, if you started off with 80% stocks and 20% bonds, a year later, you might find yourself with something like 70% stocks and 30% bonds, or maybe 90% stocks and 10% bonds, depending again on how the market moves. Rebalancing is the process of bringing your portfolio back to its initial asset allocation. Here's how to do it. You sell some shares of the ETF that has been doing well, and use the proceeds to buy some shares of the ETF that has not been doing as well. It might seem counterintuitive, but this rebalancing discipline is essential for maintaining your risk profile over time. It ensures that you're always buying low and selling high instead of the other way around. Rebalancing is typically done once a year on a set date or whenever your asset allocation has drifted significantly from your initial plan following a major rise or drop in the market. Next, ignore all financial news and forecasts. The media sells the delusion that if you are smart enough and you follow the financial news and forecasts, you could gain a competitive edge in the market. Nothing could be further from the truth. Unless you're wise to this trap, it's easy to fall for it. While the stock market rises over the long term, no one can accurately predict how individual stocks, sectors, or even the whole market will behave in the short term. And don't just take my word for it. Here's what Warren Buffett said. We've long felt the only value of stock forecasts is to make fortune tellers look good. He also added, we believe that short-term market forecasts are poison and should be kept locked up in a safe place away from children and also from grown-ups who behave in the market like children. Therefore, to be a successful investor, it is best to stay the course and ignore all financial news, no matter how catchy or scary the headlines seem to be. The next and most important step is to avoid common mistakes. Successful investing is about doing a few things right and avoiding mistakes. However, this is usually easier said than done. And because we're emotional, we tend to make irrational decisions that compromise an otherwise solid investment plan. Even the most experienced investors make mistakes that jeopardize their chances of success in the stock market. I'll be walking you through the most common investment mistakes and how to avoid them in this next video. So click or tap this video card on the screen and I'll see you there. Or click or tap this card for another video. Remember to subscribe if you haven't to get notified when my next video comes out. Thanks again for watching, and I'll catch you in the next one.